Hello, everyone. Welcome to episode 3 of Michael Fang's of my podcast. So it's been a long time since I did the last one, but after the news of this week, I was just honestly so pissed off. I felt like I gotta get it out. So um, I think that I actually know how Alameda Research blew up. Um, I think that a lot of people don't really realize how they made money, how they lost that money, um, but also kind of like why he didn't just let Alameda just die. Why couldn't he just let it die and hold on to FTX? Well, I think I know. So stay tuned, and I'm gonna just walk through these tabs here to try to explain why, and hopefully you'll follow along, and just let me know what you think. All right, so let's start at the beginning. Um, my Eric Hummingbot really started as a quant trading firm in the Bay Area in 2017 called Coin Alpha. Back then, there were very few, quant crypto hedge funds in the Bay Area, so we kind of all knew each other. Galois Capital was another one that I'm still really know well today. Alameda Research didn't really hang out with us that much, but we all kind of knew who they were. And we actually had a chance to discuss their structure, especially this kind of investment offering, term sheet that has been floating around. Um, Now, what's interesting is that I think everyone is kind of, basically raising a fuss about this line here, which says that these loans have no downside, we guarantee full payment. And people are like, how can you kind of do that? It sounds like a guarantee of return, so to speak. But I think the more interesting piece is this part right here, which is the actual structure of the loan itself. Now, if you're familiar with how most hedge funds work, it's typically it's an LP GPLP structure where the investors coming in and essentially purchasing equity in the partnership. This is a debt arrangement. So FTX, instead of raising capital by equity, they were just borrowing that money from a lender, and they were doing this way back in. And I think this is probably 2018, actually. Yeah, I think when I was talking about this. So, and what's interesting there is that the investors were just essentially looking at the returns from Alameda, which were actually very good. I think they were probably like my guess would be somewhere like 5 to 10% per month. Because the kimchi trade and just doing OTC in general was pretty lucrative, and I think, and also I have to admit, Alameda was very good. They were one of the best quant funds at that time. Their returns were very good, and I think they were able to raise at this kind of rate. However, this structure wasn't like, if you went to the bank and try to get a loan, the bank would try to have covenants and say you have to maintain a certain loan to value ratio, kind of have these like financial covenants. This, not only was this a quant hedge fund, but typically there was only a very small slice of equity below that. I think he mentioned like something like $5 million of equity versus maybe like 60 or 100 million of debt on top of that. Moreover, this is not like a business. This is like it's a market making operation. It's like so it is a business, but it's a very volatile business. It's one where like if there was a big drawdown or if the exchange that you're on is hacked, then you lose a lot of capital. So it was a very risky structure, but I think that they were a very good quant firm, so they were able to raise probably hundreds of millions of dollars in this structure. But I mention this because this is really, I think, like how Alameda was set up as a firm. Their DNA was to essentially add as much leverage as possible to the structure, and when you make money, it's taken out of the firm, and then like funding effective altruism things or venture or something else that Sam wanted to do, but it wasn't, the profits did not flow back into the business, so to speak. So that's one. So I think Alameda actually did very well with that. But the thing here is that the type of market making that we're doing, which is quant market making, which is an area that we're pretty familiar with because a lot of people use Hummingbot for this type of trading, and Coin Alpha, our parent company, also does quant market making. Quantitative market making is actually a fairly capital intensive and fairly it's not a very risky type of strategy. So that's actually one reason why they were able to get these kind of loans, is because they were basically just doing arbitrage, doing OTC, basically making money off of all market volatility across the board. But because you need capital in lots of different venues, you have to basically rebalance, and frankly, you're dependent upon the market to trade in order for you to kind of capture that alpha. It's actually hard to make a lot of money really quickly. So the first question I think people have is, how did Alameda actually make billions of dollars that they apparently made in the last couple of years? So I feel like to understand what really happened, we had to start with SushiSwap, because I think this is really where Sam broke bad. Let me give you some backdrop. So Uniswap had launched, way before that, but it didn't really start taking off until basically like June 2020. Because then people started doing kind of airdropping rewards, then which kind of created this yield farming industry, and then birthed all these like DeFi degens out there that were staking tokens in these liquidity pools to earn yield. Then one day, this project comes along called SushiSwap, and it was a clone of Uniswap, and they had their own sushi token, and they were basically airdropping their token to people who would move their liquidity from Uniswap to SushiSwap. Back then, this is seen as outrageous, completely improper, and so that's why they called it a vampire mining attack. I think today it's basically commonplace. It's almost... But the most interesting thing about SushiSwap was actually its creator. So this was someone named Chef Nomi, an anonymous developer who committed some code in 2020, basically the clone of the fork of the Uniswap contract, and kind of modifications to make it work. He was a person that created the initial SushiSwap code base. But then after it got really big, Chef Nomi disappeared with a lot of the dev fees inside the SushiSwap contract. So this is actually talked about in this article here. This is the actual transaction that Chef Nomi did to withdraw the dev fees. It was a total about 13 million of ETH that Chef Nomi made away with. This obviously threw the SushiSwap community into a uproar. Was this legal? Maybe it was, or was this a hack? And who would actually lead the project going forward? Well, into that void steps a white knight, someone who was already a large sushi holder. And who would that person be? None other than Sam Bankman-Fried. All right, so Sam comes in and he's like, "Hey, I'm just an individual holder of the community. I'm gonna help organize this project, because I own a bunch of the sushi tokens, and I have no idea who Chef Nomi is, and I'm gonna just help out here." And then magically, a few days later, Chef Nomi returns all the money he stole or hacked or whatever, and then Chef Nomi disappears into the ether and is never heard of again. So this was his or her last, the Twitter account, and this was the last tweet that they sent. So note the phrasing: "To everyone, I fucked up and I am sorry," along with a large list of like Oscar thank yous, and all that jazz. So note the similarities in language to the language that SBF used in his mea culpa a few days ago. I'm sorry. That's the biggest thing. I fucked up. I should have done better. To everyone, I fucked up, and I am sorry. Pretty close, and I think I'm not the only person who spotted this. If you look at the comments on this tweet, there's lots of people who also think that this is Sam Bankman-Fried. Sam, is it you? Lots of stuff like that. But to me, I think the overarching lesson here is the takeaway here is this is when I think Sam learned that he could create kind of like tokens from thin air. So at that point with Sushi, I contend that because SBF was behind the whole thing, he basically held all of the Sushi tokens except for the bit that he was dropping off, airdropping to the community via the mining campaigns. But the vast bulk of the Sushi tokens, I believe, was just held by the insiders, which was basically SBF. So at that point, essentially a few days after SushiSwap went live, it was already trading at a price of $10, and that's because there was a sushi to USD market on SushiSwap itself, and so someone could set the price and someone could put in reserves, and then basically see how the market kind of took that price. So because people kept depositing assets into SushiSwap, incentivized by the Sushi rewards, it also kept driving up the price of the Sushi token. So I think this is when SBF kind of learned that he could basically use these incentives in order to kind of like compel people to put in capital, and the price. No one really looked at like the fully diluted market cap or anything else like that. They just looked at how much yield could they earn in that native token, and so kind of kicked off even more like yield farming and so forth. And so at that point, there was essentially this asset was worth $3 billion in fully diluted market cap. So I think this kind of experience with tokens is really where SBF kind of saw DeFi as a casino almost, and that he could basically start to find opportunities to collect these like asymmetric options where you could like spend very little capital, but if you could kind of convince a market this asset was worth X, then you could sell it for X. So but at that point, I think Alameda itself was still doing its traditional quant market making activity. So this is, I believe, when Alameda started to focus on a different type of business. So what SushiSwap and its mysterious founder, Chef Nomi, what they really taught the market was that you don't actually need to invent anything new. Instead, you could just clone an existing DeFi protocol and then create a token and then try to incentivize people to kind of stake, remove their stakes in that protocol and put them into your protocol. And so that, I think the market would learn that anyway, but I think SushiSwap was really kind of like one of the first innovators of this so-called vampire attack. But then this kicked off a huge, like a wave of, of tokens launching. A lot of these like food tokens, like yam or potato or other things like that. And Alameda was actually one of the largest seed investors in across the board, and not just in food tokens, but in a lot of other projects as well. So if you look at their portfolio on Crunchbase, you can see that they started to invest really in kind of like August 2020 with perpetual protocols. Some of these are like DeFi exchanges, like Sif Chain is a Cosmos DEX, or is it Omni DEX? I guess Frontier is a DeFi project on Ethereum, and Paraswap is an aggregator, kind of like 1inch. Dune is done very well. They're a DEX DeFi analytics platform. But so you can see across the board, Alameda was probably one of the most active investors in Web3. And but what was interesting was that I think their strategy was actually different from a lot of the other VCs in these rounds because their check size was not very large, maybe like 50K or 100K or so. They did lead some deals, but they weren't super, kind of trying to elbow people out of the way. And that's because I think the investment was really a way to get the foot in the door into the getting the market making business for that token when they launched. So I think that let me first explain. I think in terms of market making, like what the motivation is for a token to actually hire a market maker. Like, why would you want to? Why do you need to hire market makers even in the first place? So imagine you're a Web3 founder sometime during the bull run, maybe in the spring of 2021. And you've created your own decentralized exchange. Maybe it's called Eggplant. And you've launched your egg token for this exchange. But now what? You're competing with all the other food token exchanges out there. And so how do you kind of get people to actually put assets on your DEX, and also how do you get people to buy and trade your egg token? So you're probably a good engineer, because you have innovated your egg exchange in some way, and maybe there's some kind of like one-sided or reduced gas cost innovation you've added into it. So the process of depositing assets into your DEX. So you could do that yourself, but then you're not sure how to manage it afterwards. How do you hedge the impermanent loss? How do you maintain kind of like security over the wallets? And more importantly, you also have your egg token as well, right? You're going to use your egg token to do liquidity mining and incentivize people to come in and put the assets in. But ultimately, you also want your egg token to be used by everyone in the world. So ideally, you want your token to be listed on the top centralized exchanges. So how do you navigate that process? Which ones should you list on? These are all questions that I think a lot of token projects have when they issue their token. And I think that's exactly what they hire market makers for. It's to navigate that process and to also place the liquidity and kind of do the actions that result in liquidity for the token. So it's kind of like half advisory, half providing the service. So I kind of equated accounting. It's like every project knows that if you have a token, liquidity is a necessary evil, and the best thing to do is to hire someone to take care of it for you. All right, so let's imagine you're a founder. You're ready to hire a market maker, and you get a range of offers from the folks out there. So there's two prevailing models out there. One's called the flat fee model, and the other one is the loan with options. So the first one is kind of the more traditional version of market making contracts. Typically, the token issuer pays a monthly fee per trading pair, and they provide tokens to the market maker as a loan for them to use in providing liquidity. So let's say in this case $50,000 of the native token, as well as the quote token, either USDC or BTC or ETH or whatever the trading pair is supposed to be. So the market maker is going out there and essentially running bots, algorithms that are kind of managing liquidity on the order book. And what they're trying to do is to adhere to the rules that they've set out for, which is to place a certain amount of liquidity within 1% spread, maybe $10,000 worth, maybe more liquidity within 2%, so cumulative, have kind of like more, like as much adhere to a certain level of liquidity within a 2% spread range, and then finally kind of placing all the liquidity provided by the issuer on the order book, within, let's say, 5%. So the market maker's job here is really to not lose the issuer's money because the market's gonna be volatile. There's what's known as toxic information, and you want to try to get out of the way of, like, let's say, big market moves, for example. So it's really providing a service, and that's one difference between kind of dedicated market making versus kind of like prop or proprietary market making. Because if you're doing proprietary, you can trade anywhere you want. So you're only going to trade where you're advantaged. But here, you're paid a fee to provide a service, and you're providing a service for a very new token that no one's ever heard of before. So you don't kind of know anything about the historical information or things about the token. So that's why it's a service game, and that's why there's a fee. So now another market maker comes along, Alameda Research, and they present a new model to you as a founder. And they're saying, well, we're not even charging any monthly fees. And we'll adhere to the same kind of spread constraints. We'll put the exact same type of liquidity on the books. All you have to do is give us, the token options, the token, and along with the option to basically buy it at a certain strike price. And so the option is typically something like to buy, between 1% to 5% of the total token supply at a strike price that's like today's price, and maybe like the more you buy, maybe like the strike price rises 10 or 20%. And the option duration is typically 12 months. So think about this from a founder's perspective. Which one do you think you would choose? Which market maker would you choose? Not surprisingly, most founders, want to save money, because their scarce asset is really the cash they've raised. They have a lot more of their native token, and so they really like the fact that option B, it was a lot cheaper, or almost free, basically. And also they like the fact that it seemed like with option B, the market maker was like, well, we're on the same side here, because if the token price goes up, then you want that, we want that, and so we have a natural incentive to support your project. So I would say invariably every project almost went with option B, and so option B kind of became the dominant market model in terms of out there, and so it wasn't just Alameda that did it. Lots of other market makers use the same exact model as well. But this essentially turned the market making, kind of like their incentive structure is essentially like a venture investment. Because the higher the price went, the more value the option was. But you might be asking, well, I thought you said Alameda was investing as a VC to try to get this kind of opportunity. If they were already investing in the deal, why would they care to invest again, right? Well, think about this type of this type of option versus what you're getting as a VC. What you get as a VC is typically tokens that have a lockup, right? The lockup is typically for 1 year, and maybe it locks like linearly after that or something. But you can't just sell your tokens right away. But here, these tokens were supposed to use for market making. So the tokens that were given to the market maker, they were unlocked community tokens, basically. And the market maker were supposed to go out there. By definition, they were liquid because the market maker was going out there and placing them on the order book and buying and selling, and allowing people to buy and sell using those tokens. So they had to be unlocked. And so usually these options start right away. And so essentially, the market maker got the ability to unlock these tokens, and if the price was very high, they could basically keep them. So it's really that liquidity that was the key difference between this type of venture investment and the normal kind of VC investments that Alameda was doing. So now I'd like to walk through an example to show you guys how lucrative this market maker token option actually could be. So as I mentioned, Alameda started really investing into projects to get this option in late 2020. So I think Dodo was probably one of the earlier ones. So Dodo was kind of like a clone of Ethereum built by the XDDEX team, an early DEX on Ethereum. And they did actually innovate upon Uniswap by having this kind of PMM algorithm that would try to essentially control for impermanent loss and help the liquidity provider get protected against big changes in market price. So, um, so so this was one of Alameda's early investments. I believe they were also the market maker for them. So let's walk through just a model case study of what this market maker arrangement would have looked like for Alameda and how profitable it could have been. So this was a token itself. This is a price chart, and so it basically started at 50 cents. Traded all the way up to a size like almost 7, and then now it's at like 12, 12 cents. And so initially it was at 50. Let's say that Alameda got a 2% option, so this would have been 20 million tokens upon a $1 billion fully diluted valuation. And so let's say the strike was also at 50 cents perhaps, and now when this chart goes up, now the option is really worth something. So if Alameda got out around $4, then essentially they made $3.50 per token in terms of option value. And if the token, if the 20 million tokens, then that's essentially $70 million in profit in terms of tokens that they had. But they could do more with those tokens. Why should they sell them when they can put them into farms? Take those LP tokens, rehypothecate them, and lever up even more. And so this was really about yield farming. So a lot of market makers also did this token option model as well, not just Alameda. Alameda was probably the most aggressive. They probably did at least, they invested in 180 million, seed rounds of projects. So they had many opportunities to market make for them, and they were market making for all the top projects, including Terra as well. But Jump, Wintermute, GSR, and other market makers also were doing this as well. But Alameda took this even a step further with yield farming, because all the tokens that they got out here, they as soon as they got the tokens, if there was a farm, they would also put them in the farm and lever up even more. And you can see this because SBF actually had a thread where he talked about what they were doing with the Cream token. And so the Cream was a fork from the Compound project, where Cream allowed you to use governance to let more tokens be tradable or be lendable in that protocol. So SBF and basically use Cream governance to basically to try to get FTT authorized as a lendable token on Cream. And the argument he makes in this Twitter thread is that essentially this token it has a price, and therefore you should be able to lend against anything that has a price. There was a lot of kind of pushback from the community here, because previously the tokens that were created were really kind of true community tokens, like Maker, like Compound, they had a use case in some type of DeFi protocol, whereas FTT was just something that's completely centralized and owned by someone, and there was no kind of like a transparency around how FTT was trading. But I think the argument that he makes here, which is that, hey, it's actually less volatile because it's less volatile in terms of price action than a lot of the DeFi coins. But why is that? Well, it's less volatile because it's so centralized. No one has any information about FTT, and therefore there's no and Alameda is market making for it. So essentially, Alameda is basically almost essentially controlling the price of FTT. So the argument he's making here is that, hey, you shouldn't be worried about a 60% move in FTT. Why? Because it hasn't exhibited much price volatility. And so this is really, I think, shows how Alameda was able to not just use the token options to acquire lots of tokens, but then also borrow against them, either in yield farming or in using things like governance of the governance tokens in order to pass a vote that allows them to essentially get FTT used as collateral in lending protocols like Cream. They're also doing this off-chain as well, with lenders like Genesis and so forth that everyone knows. They actually ended up in a situation where that's why Alameda was the most levered crypto hedge fund out there, which is something people didn't realize, of course, until recently. But who are the losers here? Where did all that money come from, right? If Alameda made hundreds of millions of dollars on each of these, different, token projects, who is taking the other side of all those token projects, of all those sales? Well, it was retail investors all over the world, people who put their money into into farms to try to earn these tokens. On the DeFi side, people who bought these tokens when they were listed on centralized exchanges. So the end buyer of all the money that basically came out of these projects all came from retail. So, but one thing is that a lot of the other market makers also use this option model. So the big ones like Jump, Wintermute, GSR, and others all also kind of use this option model to get incentivized to do market making for projects. So how come they didn't blow up, or did they? I do think it's different because there was market making and there was a yield farming part of it, right? And so I believe that the other market makers did not do as much yield farming as Alameda did, whereas Alameda essentially combined both. He essentially took the profits that they made from getting the token options and essentially did the same thing as 3AC in terms of levering up into yield farms. But the other thing that the other market makers did was when they actually made profits using HFT market making and the kind of servicing tokens and getting options, they kept the money inside the firm. They did not go out and spend money on things like this, where $580 million Series B into an AI startup lab that had started in 2021 or 2020. So it was 1 year old when FTX led a $580 million round into this company. And essentially FTX, did not do this, which is when Wintermute reported their exposure to FTX, the Wintermute CEO, their holdings were 55 million, and it's still there, and they said we're fine even after that $55 million loss. And someone said, well, you guys just lost $250 million in this hack, and you just lost another 55 million. If you still have 400 million equity, did you really make like 625 million in retained profits since inception? And Evgeny basically says, you should apply for a job here. You're pretty good at math. So I think the difference between Alameda and the other market making firms was that the other market making firms kept their profits inside the company. They didn't go out and buy, AI safety companies and spend a lot of money on other things like this, where this is the entire kind of the types of investments that FTX and Alameda were making, very illiquid, huge investments into blockchain protocols and so forth. And essentially, this was essentially investing more into their business, though, because the more that they invested into these ecosystems, the more access they had to market making for these tokens and then any other tokens issued by these ecosystems. So Alameda was just in the business of attaining as much leverage as possible. So I think there's one final question we haven't answered yet, which is why he didn't just let Alameda fail. SBF had already extracted billions of dollars out in 2020 and 2021, and as he told Sequoia here, apparently got them super excited and just throwing money at FTX. He said, I want FTX to be the place where you can do anything you want with your next dollar. You can buy Bitcoin. You can send money in whatever currency to any friend anywhere in the world. You can buy a banana. You can do anything you want with your money from inside FTX. So there's no mention of Alameda Research anywhere here, right? So, according to him, it wasn't even in the picture. So why was it so crucial to him that he was willing to risk everything to save it when it was about to go under? So I think the credit to the person who broke this story was really this guy on Twitter, Doug Colkett. So I'll post the thread. I would encourage you to read it. But let me try to explain it, from my perspective. So it was well known that FTX was the best trading exchange for kind of sophisticated trading firms, and that's because they had a really good API, like a really rock solid kind of support for quants, and they're real engineers, and they had the lowest fees in the industry. So these are their kind of fee schedule. So you can see that they have 0.07% taker fees at the first tier. Typically, this is 0.25%, I think, in terms of Coinbase. I think Kraken may even be 0.5%. So the top exchanges are higher. Binance is actually even Binance is 0.1% taker is higher than FTX. But in addition, if you hold FTT, you can reduce your fees massively as well. So if you hold $5 million of FTT, you can get a further 60% discount on your trading fees. So this is so essentially, if you're trading a lot of volume, you basically are paying almost nothing in terms of trading fees. Meanwhile, if you held FTT, you could also withdraw for very little as well, and you could even you can make rebates if you staked FTT. So in my opinion, FTT really didn't make a lot in terms of fees. But the other thing was to attract these traders. Someone had to be setting the quotes on all the pairs. So remember we said that dedicated market making, if you have to market make for everything, and you have to do it, then it's probably you're probably gonna lose money. And that's, I think, what was happening, which was Alameda from the get-go was kind of propping up FTX by market making at super tight spreads. And the tight spreads, the low fees, were what attracted the quant trading firms to focus on FTX, because they could make more money on FTX than they could on other venues. And I think we can see this if we look at a tweet from Galois Capital on May 18th, where he showed the leaderboard where they're the number 25th most profitable quant firm trader on FTX. So this is really good for obviously there's many traders on FTX, but it's the fact that there's other quant funds here, this is probably quant fund here, and there's other 24 other traders even more profitable than Galois. It kind of shows you how why it was better on FTX than other exchanges. So essentially what was happening, in my opinion, was that Alameda, FTX never really made a lot of money in the first place. But it was basically the volume of FTX and the kind of the high profile brand of the exchange allowed FTX to continue raising capital at higher and higher valuations for FTX as a group. But the money was always supposed to be made by Alameda because that was a trading firm. And so this kind of game worked in 2020 and 2021 because Alameda was able to make billions of dollars a year off of yield farming. So maybe the few hundred million, let's say, that it had to essentially leak out to market make very tight spreads was that was another kind of a loss leader, so to speak, for FTX as a whole. However, when Alameda, when that flipped after the Luna crash, and suddenly Alameda went from a business that was throwing off $1 billion a year to one that was now in the hole, maybe my guess is $1 or $2 billion, maybe more, maybe 5, I don't know. But at that point, I think Sam had a choice. He could either let Alameda fall, and kind of like focus on FTX. But then, you know, no one would be quoting those super tight spreads that attracted all the quant firms in. And and so if the quant firms left, then the volume would drop, and then he would be kind of like, raising a down round, and so forth. So so I think that obviously I'm sure he wishes in hindsight he had taken that, like taking some chips off the table. But I think if you look at the trajectory of, kind of like he's been on, it's always about more and more leverage. Let me end with my thoughts on Sam Bankman-Fried. So he did this podcast with Matt Levine, and I only really saw this until a few days ago, but I read it and I realized he actually told us exactly who he was. Because when Matt Levine asked him to explain yield farming, essentially defend DeFi, he didn't talk about how the yield comes from the opportunity cost of capital borne by stakers and LPs, the exact same way it does in TradFi. He didn't talk about how yield farming is just an example of the composability overall of DeFi, and that's the difference between that and the TradFi world of SPVs and paper certificates. Instead, SBF, he just thought of DeFi as a giant casino, starting with being the mastermind behind the SushiSwap debacle, abusing cream governance to force FTT to be used as collateral. He just kept levering up while extracting billions in profits to fund his own personal ventures. He never cared at all about the mission of DeFi. But as he paints this picture of deal farming and DeFi being this gigantic Ponzi scheme, I just can't help but think, you're a genius trader. You should know that for someone to win a trade, someone else has to be losing the trade, right? He knows that everyone can't make money. Everyone it makes money. The line "everyone makes money," I think here somewhere is that everyone. Yeah, look at this. He says, "This is freaking bonkers." Oh wow, this thing's now yielding like 60% a year in tokens. Of course, I'll take my 60% yield, right? And so they'll go and pour another 300 million into the box, and you get psych, and it goes to infinity, and then everyone makes money. Look, for a guy as smart as SBF, he knows that that's a lie. He knows that for every trade, there's a loser. There's a winner and a loser. And the losers here, who are the losers? The losers are all the people who bought Sushi, FTT, SRM, and all the other tokens that Alameda farmed and dumped onto the global retail population. And it includes everyone who trusted their life savings on FTX, all the individuals, as well as all the projects and the funds. So I think this actually might be the biggest crime in history in terms of the number of victims affected. There are probably over 1 billion victims here. Ten years ago, Ross Ulbricht got 200 years in jail for operating Silk Road. Silk Road was a tiny online marketplace where a few thousand people bought weed using Bitcoin. There are literally thousands of Silk Roads operating legally in every major US city today. So I think they should either give SBF a lot more years, or at least equally as long a sentence as what Ross got, or they should commute Ross's sentence to a fraction of what SBF's is.